Now, based on how we finished the last segment, it makes sense to just reiterate or use these charts to just highlight what is happening at the consumer level. Where are we on the debt side? And here, auto loans and credit card balances. U.S. consumers have added more than $1 trillion in aggregate credit card and car loan debt over the past decade. Car loan side, I think last month it was only 8% of cars were under 30,000. So you're looking at some big pressure points when you look at the increase in pricing. The UAW, or which is the auto worker union, are looking for a 40% increase in wages, which, if car companies want to maintain their margin, would obviously have to continue to raise prices. And that's going to put that additional pressure on the back end. Now, the credit card side is going to continue to get worse because your credit card balance goes up, especially when you look at rates sitting at 22, I should say credit card rates sitting at anywhere between 22 and 24%. That compounds quickly. And unless you're paying that off aggressively or not carrying one, you're going to see that continue to expand. And just given where rates are and where we think the Fed is going to go, that's likely going to move up once again. Now, the credit card debt surge. U.S. credit card debt is up almost $150 billion over the past year. Essentially, really completely wiping out the benefit that we saw during the pandemic, where a lot of people were putting stuff into savings, reducing their credit card spending. That has been reversed in a massive way when you look at some of those shifts. Now, rising real wages, will drive businesses to crack the productivity whip, which just means that you're going to want people to be more productive if you're paying them more. And yes, it's starting to kind of marry with inflation, but you're still not closing the gap. So people are still relying on credit. They're still reducing their, what they're spending. And at the same time, as wages go up, companies that are trying to maintain or protect their margin are going to raise pricing or try to keep prices as high as possible, which is going to then create that feedback loop, which is what we like to call with the wage price spiral. Transition into serious delinquency, 90 plus or greater for credit cards by age. You see that it continues to move up, especially for that really important 30 to 39 individual. Now, we have some other charts that we're going to look at, but when you're considering having a family, and for someone who has 3 children, they are expensive. And if you're in that, which has obviously slipped further in terms of that pressure point, if you're between the ages of 18 and 39, which I think for all intents and purposes for this conversation is prime baby making, baby rearing periods. Well, if your delinquency is going up, do you really have the wherewithal, or I shouldn't say wherewithal, but do you have the means to have a child? Do you have the means to have more than one child? And realistically looking at this, the answer is becoming further and further no. When you look at the ability to have a house or because for anybody who has children can attest to the how real the nesting component of pregnancy is. If you don't have a house, if you don't have comfort in where you're living, you'll be less likely to have one if you don't have space. So everyone looks at and says, oh, well, we need to have more babies. The population is shrinking. It's like, well, how can you afford to? How do you have the space to do it? And that's where we get a lot of these pressure points. Now, again, this is just looking at things as they come across. The cost for a U.S. middle-class family of 4, and it's just using the old adage of a male income. So now, when you look at it, a single working man not a single, but a working father and husband cannot afford a family. And that is depressing on a lot of levels for anybody like myself who is trying to support and build a business and not being very successful at it at the moment. It's a problem. You see that the inability to deliver, and yes, women are working more. So, but it's just showing you that you need 2 salaries. It used to be the second salary was good to have. That would go to savings for retirement. That would go to having more vacations. So if the man's salary is falling, Well, the female salary is catching up, and which is good. We're not saying that there shouldn't be equal pay, but you're going to eat into, well, how much money is there for additional spending? If now the woman's, or the woman's salary is trying to make up for just living expenses, well, that's less going to retirement. That's less going to spending. That's less going to vacations. And that is a pressure point when you look at how this is eating, because even though more women are working, we aren't at equal pay. So let's just say, I think the most recent numbers is for every dollar a man makes, it's now 70 cents for a woman, or 73 cents for a woman. So now the man is not closing that gap, and the woman is not getting paid equal either. So now you're seeing the additional tightness. And if both parents are working, there's also going to be additional costs that aren't picked up when you look at just one parent working. That's childcare. You're likely going to eat out more, or have more takeout, because there's just less time to cook. You may have a cleaning service or some sort of help on a weekly, bi-weekly, once a month level. So again, there's additional costs which just eat into where we're really going as not just a society, but in terms of spending. How is spending going to change? And that's a lot of the pressure points that we're going to continue to see. And as you could see from, there was that crossover in 2000, but food was really kind of that bellwether. And you can change food. You can eat out less. You can change, not going to Whole Foods, going to Walmart or Target or some sort of, and that is now diminished. Now you're eating directly into transportation, healthcare. And healthcare prices have gone up. My healthcare costs, we pay monthly. I think we're at $2,900 for a family of 5, and it's going to go up again. And that's a problem that we keep seeing. But when you look at consecutive months for unemployment, it remains very tight. So it's like, at what point do we see these problems where it's like the Fed has to raise rates to bring down wages, but because the unemployment rate is telling you that we're still well below where we should be for natural unemployment. And that, again, when you go back to it, now 18 months of sub 4% unemployment rate, which is the longest streak since one that ended in 1970. Now, it's interesting because for those that have been watching us, we've been saying that work from home, the flexible schedules were going to be very consistent going forward once we got to this point. And July 2023 office visits were down 37% from pre-pandemic levels. And again, that's looking at the same period, because obviously people are in the office less in the summer. But then when you look at Kastle back to work barometers, when you look at some of these big areas, realistically, the amount is staying the same. We are getting some push to go back into the office, but for the most part, 45 to 55% is still a flexible schedule, work from home, and that is going to eat into, as we've talked about, gasoline demand and that underlying activity that we see during the week. Now, for non-supervisory workers, average hourly earnings growth reaccelerated to 5% in July, which is consistent with peak growth rates in mid-1980s to late 2010 timeframe. So you're seeing that payroll go back up, but you could say, well, that's good because it's helping to close the inflation gap, but at the same time, it's helping to support the inflation gap because now people are going to pay up, and this is we're getting into this cycle which Powell wants to avoid. So I think until you see this meaningfully break, and they'll never say that they're trying to break it because they can't. There would be riots in the streets, but realistically, this is what they're trying to break. They don't want wages to keep going up. They want them to come down, so then people really start to cut into spending, and you start to see this work through the system, which right now you're still seeing it, that beginning stage or the beginning fears of that wage price spiral. Revolving consumer credit contracted in June by 0.6% year on year, which was the first decline since April of 2021. So you're starting to see it come down because, again, revolving the credit card side, but credit use reaccelerated in June, with consumer credit increasing by $17.85 billion versus the estimate of $13.1. But credit card debt saw its first decline since 2021, but yet but you're still seeing debt go up because the cost of debt, excuse me, has increased when you're looking at credit cards, but also car loans. So it's a balancing act. Now, we've been saying that there's been in July, you've seen that we finally have seen negative retail sales. You're starting to see that negative side, and that usually comes with less credit card debt. So we started to see the credit card debt coming down in June. You started to actually see that bite into retail sales, and that acceleration, we do believe, continues. Financial stress: fewer U.S. adults said they could pay for a $400 emergency expense with cash. And you can see the segment between April and July: checking, savings account, or with cash. As you can see, it continues to diminish what people can afford, because shrinking number of Americans can afford it. Per a recent Morning Consult survey, 46% of respondents said they could cover surprise expense, which is down from 48%. 1/3 said they need to use some sort of debt. And then when you look at household borrowing costs, you get an idea on just how elevated everything is, especially when you look at the credit card side, which is compounding and again impacting things exponentially. Credit card limit and balance: so $1 trillion in credit card balances and another $3.5 trillion in untapped credit card limits. So even though we've seen credit card balances go up, technically could go higher. And that's a scary fact when you start looking at HELOC balances, credit card balances. People are starting to hit that level where they've hit the HELOC limit. They're above the balance, and now it's just all going to be credit card, which HELOCs will move. Yeah, I think right now the average HELOC is anywhere between 6.5 and 7.75, which is better than a credit card that's going to be sitting there at 22%. So again, you're seeing those pressure points continue. Now, net spending intentions over the next 6 months, there's obviously a huge decline in consumer electronics, toys, small appliances, leisure, entertainment, and activities. Remember, leisure, entertainment, activities, food away from home. These are all discretionary items over the next 6 months. So as we've been saying, they're going to get a lot of pressure when you look at travel. Travel is not going to get better. Fed's survey points to steep downturn in consumer credit, and it's just because the outstanding credit's going to come down because the bank willingness to make consumer loans isn't there, because they're like, well, you're already stressed. I'm not giving you more money because your leverage is only going to get worse and you can't afford it. Revolving consumer credit, and then real revolving consumer credit. And that's where you have to look at that disconnect. And so you've seen real revolving credit, consumer credit is still lower when you look at how accelerated inflation is, but it doesn't mean that you feel any wealthier when you look at that spending side, because those numbers continue to get worse for you on a month-over-month basis. Revolving consumer credit owned and securitized versus disposable income. This is what we were talking about. Net, people are still better than where they were because the cost of mortgages is so much lower, because mortgage is and rent is typically a huge component. Rent is shifting back up, but mortgages are shifting back up. But again, if you have a 30-year rate lock, rates could go to 15%. It doesn't matter. You still have 3%. So that provides this stability and this support, which is, so while mortgages stay down, the credit card side, the auto side is going to continue to worsen and continue to make things worse on that front, which is why when you look at wholesale inventory versus sales ratio ticked back up in June and is back to where it was in March before the pandemic. Only comparable ratio was during the great financial crisis. So again, you're seeing that pivot back up. You're getting some of the inventories that have been building and that slowdown in sales. June wholesale trade sales came in at negative 0.7% versus the estimate of negative 0.2. Inventories came in at negative 0.5 versus the estimate of negative 0.3. So trade sales, bigger decline, and inventories, declined as well, but smaller decline. So again, you're just seeing that slowdown in general, which is why you're not ordering, which is why you're seeing that, again, move through the supply chain system. Then you look at another measure of labor market tightness, which is the percent of job leavers. As of July, share ticked up to 14.6%, which is not far from cycle peaks. But remember, this is also showing that you still have more labor tightness, which is not what the Fed wants to see. Every monthly payroll number in 2023 has been revised lower. So again, you see a better number, and then they take it down, and you forget to look back. Now, depending on who you are, but every monthly payroll number in 2023 has been revised lower, and that's helped to kind of manipulate perception, kind of show things are a bit better than they are, but they're still positive. So that's, again, where you could try to say, and this is obviously a zero hedge chart because they're like, oh, look how crazy it is. It's like, well, there's always revisions, but, realistically, we're still positive. You still have tightness that you shouldn't have. For the month of July, the economy added 972,000 part-time jobs, which was the most since October of 2020. Number of full-time positions fell by 585,000, which was the worst drop since April of 2020. So again, you're starting to see some of those underlying shifts. When you look at the intermodal, as we talked about in the EIA show, it started to come back up, but you're still well below where we were in 22, 21. And the pressure is there when you look at the fact that, everyone has been fairly sluggish in buying. So you still have to have stuff in stores. So we're just not going to see a meaningful move up. ISM service PMI was expected at 53.1, came in at 52.7, but ISM services prices paid went up. So again, prices paid, inflationary, showing that increase. But activity slowed, but you're still seeing that pressure on, as we've been talking about, the inflation side. Home buyer housing payments are up 19% year on year. Monthly mortgage payment on a median asking price home climbed to $2,605, up 19%. The average fixed 30-year mortgage rate is back to near late 2022 highs at over 7%, which again, it just bites into a lot of these underlying pressure points, which we continue to see, and why we are seeing more pressure here with mortgage purchase index has reversed lower and is back to testing its February lows because everyone's like, well, I can't afford it, and people are getting rejected for mortgages, which is, again, a leading indicator on where the pressure is going to be. But the cost of buying and renting a house in America has skyrocketed since 2020. Buying a house now costs $2,700 a month on average, up an alarming 86% in 3 years. Renting a house now costs $1,850 a month on average, up 25% in 3 years. Owning a home is a luxury, which is why you've been seeing tightness in rent, because people just can't afford to buy, so they're forced to rent. But if you rent, do you have less space? If you have less space, you have less, ability to have multiple children or children at all. And again, that creates this cycle that is only going to get worse. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into Europe and how some of the things continue to worsen on the European front.